Hey everyone, and welcome to AI Explains ICT. So, you're looking to get a real handle on swing trading, right? Well, it all starts with building a super strong foundation. And in this video, we're going to break down the exact framework ICT lays out in his core teachings. Let's get into it.
Specifically, we're jumping right into the core content from Month 6, Episode 2. Now, ICT points out from the get-go that this one, it's a little different. It's not your typical chart walkthrough. This lesson is all about building up that theoretical muscle and really testing your understanding of the concepts.
And he's not kidding, it is all theory. There are 0 chart screenshots in this one. What does that mean for you? It means you've got to really listen, absorb the ideas, and build that mental model in your head. You can't just rely on recognizing a pattern on a chart. This is all about deep, fundamental comprehension.
So I'm serious here. You're probably going to want to grab a pen and paper or open up a notes app. This is an active learning session, because by the end of this, you're going to be taking all this theory and putting it straight into practice by building your own mock trading plan. So, are you ready to build that framework for successful trading?
Okay, first things first. We need to zoom out and look at the big picture. Before you even think about an entry, there are some key market conditions, what ICT calls hallmarks, that absolutely have to be there. You can think of them like a pre-flight checklist for your trade. These are the big green lights you need to see on those higher time frames.
And here's that checklist. This is really your first, most important filter. You got to ask yourself, is the trend on the higher time frame just obvious? Is the institutional order flow crystal clear? Do we have support from interest rates and intermarket analysis? And crucially, are there clear premium/discount arrays or PDAs that give us a map for where price might go? Now the last two, COT data and seasonals. ICT calls those optional, but hey, the more of these boxes you can check, the more confident you can be in your trade idea.
Let's double-click on one of the most critical hallmarks here, institutional order flow. And you know what? This isn't some super complex, secret concept. It all boils down to one word: clarity. When you pull up a monthly, weekly, or daily chart, does the market's intention just jump out at you? Is it obviously aggressively reaching for higher prices, or is it clearly breaking down to go lower? The rule of thumb here is simple. If you have to squint and search for the trend, it ain't there. Move on.
And that exact same idea of clarity applies to your premium and discount arrays, your PDAs. We're talking about things like old highs and lows, fair value gaps, order blocks, the levels that act like magnets for price. These have to be so clear that anyone could spot them. If the levels look messy or ambiguous, then your whole trade idea is built on, well, a pretty shaky foundation.
Okay, so let's say your high-level view checks out. Everything looks good. Now what? Well, now you have to confirm that the big players, the institutions, are actually on your side. How do we do that? We look for their footprints in the price action. And that's exactly what this next part is all about: becoming a detective and finding those institutional footprints.
And here's the secret decoder ring. In a bullish market, when price is going up, institutions are accumulating. They aren't chasing the highs with everyone else. Nope. They're buying on the dips, on the down candles, and those down candles then become support. Now, flip that for a bearish market. Institutions are distributing. They're selling into the rallies on the up candles, and those up candles become the new resistance that pushes the price even lower.
This leads us to a really key quote from ICT himself. He says, "We measure bank accumulation by buying at down candles, and we measure bank distribution at up candles as resistance." Just let that sink in. It's such a simple but powerful way to look at a chart. It literally tells you where to look for the evidence that the big money is involved.
All right, so now we know what macro conditions to look for, and we know how to spot the bank's activity. But here's the thing: not all charts are created equal. A huge piece of the puzzle, a skill that separates the pros from the amateurs, is knowing which markets to even bother with and which ones to just ignore. It's all about finding the cleanest charts.
So what does a clean chart even look like? Well, you're looking for price action that is just smooth. It's easy to read. The PDAs are super obvious. You can see price being drawn towards some big old imbalance on a monthly or weekly chart, and you'll see price just beautifully, almost elegantly, respecting those key institutional levels like the double zeros and the 50s. That's the environment where your odds of success just go through the roof.
And ICT has the perfect way of describing this. He says the best setups are the ones that literally leap off the chart. I mean, think about that. If you're sitting there staring at a chart trying to convince yourself a setup is there, it's not. If you have to debate it or second-guess it, just walk away. The A+, highest probability trades are always the most obvious ones. No question.
This brings us to maybe the most important part of this whole thing. And it's not about the market.
It's about you. Because you can have the most perfect read on the market, but if you don't have the discipline to act on it the right way every single time, it's completely useless. And this is where your personal rulebook comes in. It's your single most important tool as a trader.
And let me be absolutely crystal clear about this. This is non-negotiable. Your rules have to be standardized and static. They cannot change from trade to trade. They can't change because you're feeling greedy, or you're scared, or you just have a good feeling about a setup. The whole point is to create a mechanical process that strips emotion out of the equation so you can execute like a machine, flawlessly, time and time again. So think of your process like a simple filter, a step-by-step flowchart. Step 1, you spot a potential opportunity based on those market conditions we talked about. Step 2, you run that opportunity through your static, unchanging rulebook. Step 3, if it fails any single rule, even just one, you're done. You pass on the trade. No buts, no what-ifs, no exceptions. It's only if and only if it passes every single check that you even think about hitting the button.
And a massive part of that rulebook has to be about risk. Specifically, ICT really hammers home the importance of seeking a minimum 3-to-1 reward-to-risk ratio. Why is that such a game changer? Because it totally flips the whole idea of a win rate on its head. When you're targeting 3-to-1, you can literally be wrong 2/3 of the time and still be profitable. Just think about that for a second. You can have a win rate of only 34% and still grow your account. That's how you build longevity and resilience in this game.
So we've covered the high-level view, how to spot institutions, where to look for clean charts, and the importance of a rulebook. We've got the what, the who, the where, and the how. So now it's time to put it all together. And this final section, well, this is your homework assignment. You're going to take everything we just talked about and build your very own mock trading plan.
So what exactly goes into a practical trading plan? That's the big question. And listen, the goal here is not perfection. Don't stress about getting it right. The goal is to create an honest, written-down snapshot of where your understanding is right now. This document becomes your baseline, a benchmark that you can look back on in a few months and see just how far you've come.
And your plan needs to answer these 5 core questions. Seriously, write them down. 1. What frames your initial opportunity? 2. What identifies a valid trade setup for you? 3. How will you determine your profit objectives? 4. How are you going to frame your risk management? And 5. What, step-by-step, is your filtering process? Be as specific as you can, based on what you know today.
And I'm telling you, whatever you do, do not skip this assignment. ICT promises that if you actually do the mock-up, you will jump leaps and bounds ahead in your understanding. And he's right. This exercise is the bridge that takes you from just passively watching videos to actively applying the concepts. It is absolutely essential for your growth as a trader.
And there you have it. That's the breakdown of the core foundations for a winning swing trade, straight from ICT. If this video helped you connect some dots, do me a huge favor and hit that like button. And make sure you're subscribed for more deep dives into this content.
Now, I know this one was heavy on theory, so it's totally normal if you have some questions. If anything was unclear, or hey, if you just want to talk through some of the ideas for your own trading plan, just drop a comment down below. We have a real person who reads and responds to every single one.
Thanks so much for watching. And I'll leave you with this one final thought as you start building out that plan. Ask yourself this: am I building these rules to help me find winning trades, or am I building them to protect myself from my own worst habits? The answer to that question might just define your entire trading journey. Good luck out there and safe trading.